Hello, this is Kelvin Davis, your multifamily newbie. I want to welcome you to my channel. Today we're talking about loans, mortgages. I wanted to give some information on how you can go about, how I'm going to go about purchasing my first multifamily property. And again, I want to thank you for coming along this journey with me. There are actually two types of loans that you'll consider, and I always recommend that you go and see a loan officer, whether it's a traditional bank or a mortgage broker, but to find out how much money you qualify for as far as the purchase. Now, I'm looking to do a residential loan because I'm going to do house hacking to purchase a property, live on the property, and basically manage it, rent out the other units. I want to do a fourplex, so I'm going to look to do a residential mortgage. But I always recommend that you go to a lender, loan officer first, find out how much money you qualify for, and then as you do your search, it'll make it that much easier because you won't be looking in the $400,000 range when you only qualify for $200,000 property. So there are two types of loans that you should consider. There are residential loans and there are commercial loans. Now, because I'm looking to do under or less than 5 units in my multifamily, small multifamily, it would qualify for a residential loan. But there are some types of commercial loans that I could also apply. So I want to talk to you about residential as well as commercial. Now, on the residential side, you have conventional loans and you have non-conventional. And the conventional loan is going to come from the bank or through a bank. Conventional way that people borrow money is generally through banks. Non-conventional is going to be a mortgage broker. You would go to a mortgage broker. Now, banks generally have different products, but they're still only that bank's products. The underlying rules or criteria are going to be the same as far as that bank is concerned. Now, you may qualify for a different program, but the overall terms and conditions, qualifying terms or conditions, are going to be the same because it's that particular bank. Of course, there are several different bank choices that you can make, from Wells Fargo to Bank of America to your local credit union. So you're not limited to one bank, but generally speaking, that bank is going to have their products. And you can see if you qualify for bank products, apply for a mortgage through a bank. Conventional loans generally require that you put at least 5% down. Of course, you can do a down payment of however much you want. You can do a down payment of 100%. But most conventional lenders require on a residential loan where you're planning on living in the property, what they call owner-occupied purchases, where you're planning on living in the property, then they're going to require at a minimum 5% down. All right. Now, if you go with FHA, even though it's through a conventional lender, a bank, FHA only requires 3.5% down. So that's why I'm looking to do FHA, my house hacking 203K loan, and we'll get into a little more detail concerning that 203K loan. But now I just want to kind of give you information concerning the difference between residential and commercial. And within residential, there's a conventional loan, and there's also a non-conventional, which you would go to your mortgage brokers, and that's basically kind of like a boutique shop where, or this guy or gal has several lenders that they deal with. Not banks necessarily, some banks, but some lenders where they're not banks, they just are pools of money that are available for lending on things like houses. And a lot of times with the mortgages, they'll immediately turn around and sell the mortgage to another company that will hold it for 30 years. You may close with one company, and before you can get out of the closing, they've already sold the mortgage to another company. But generally speaking, your non-conventional loan products are going to go through or come through a mortgage broker. Now, those are your residential loan choices. There are also commercial loan choices where, commercial, I said that right. But with the commercial, you'll have to generally put down, according to the lender's criteria, from 20 to 25%. All right, so it's very different from the residential owner-occupied. Now, if you're doing a loan where you're not planning on living in the house, then, like I say, you're an investor. You're going, even if it's a single-family house, they're going to see you as an investor, and you're going to have to put down much more than that 3 to 5%. So that's another thing if you're an investor. But we're talking owner-occupied on the residential side, because that's what I'm planning on doing. On the commercial side, whether it's owner-occupied or not, they're going to look for you to put down 20 to 25%. Like I say, according to the lender. The commercial loan that I would consider, the only one that I would probably consider, is the DSCR loan. Now that DSCR, debt service coverage ratio. They're going to look for a certain ratio that debt service is being covered. So they're going to look at the property itself. They're not looking at you as the individual purchasing the property. With the residential loan, they're looking at you, your income, your W-2s, your savings, everything that you have, your credit, everything that you have to basically substantiate or to say that this, to qualify you to take out this loan. Everything that you have as an individual that says, I'm a good credit risk to take out a loan. Whereas with the commercial, the focus is more on the property itself and what it can do, especially with the DSCR loan. They're going to look at not you, your W-2s, your income, but they're going to look at that property and see what it's bringing in as far as rent is concerned. And if the rent is able to cover the debt service at a certain ratio, most lenders are looking at not 1-to-1, but 1 to I'm going to post the number, but you want to be making at least 1.5 times or 1.2 times what the debt service is. So, and we're going to do the math. I'm going to go into a little more detail concerning debt service coverage ratios. But the point I wanted to make on this short video is that there are residential loans and there are commercial loans. The residential, you can do conventional, non-conventional. You can do FHA with the conventional or FHA with the non-conventional. The conventional is usually with a bank. That's what that is. A conventional loan is through the bank. Non-conventional, you'll go through a mortgage broker. On the commercial side, they're going to require 20 to 25% down in opposition to the residential, where you can get away with, if you do FHA, 3% down. Conventional, you have to do probably 5%, at least 5% down. But with the commercial, you have to pay upwards 20 to 25% down to purchase the property. The DSCR loan, they're not looking at you as an individual, they're looking at the property and what it's able to do as far as rents and different forms of income. And if the ratio is right, then they'll make the loan to you and you don't have to worry about the fact that you're say 1099 or self-employed person and you've written everything off to where it looks like you earn very little money. It doesn't matter. It may matter on the residential side because they're looking at you, but on the commercial side, it won't matter. So that's this short video. Again, my name is Kelvin Davis, the multifamily newbie. I want to thank you for coming on this journey with me, and I look forward to seeing you at the top.